Hello, everybody. Thank you so much for joining me today. For today's video, I want to recap some of the trends I've been seeing in the auto market that keep pointing to this thing where legacy automakers and new EV commerce are struggling mightily, while there's one player, at least in the United States, in the case of Tesla, that's performing well above expectations. So without further ado, let me go ahead and get us started. And as always, Sawyer Merritt, he seems to be on this channel quite a bit because he always puts out great information. If you don't follow Sawyer, please do on Twitter at Sawyer Merritt. We'll use a flame pointer today because I think legacy auto is going up in flames, but it's my opinion. Here we go. Let's dig into some of the things that I'm seeing. News: General Motors said on Thursday that it will halt production at its Fort Wayne assembly truck plant in Indiana for 2 weeks from March 27th as inventory starts to outweigh demand with the easing of supply chain snags. Now, this is a very interesting headline coming out of GM because during their Q4 earnings, they were really upbeat about how well they're performing, about how well they're going to do in 2023. Yet we have a factory shutdown in Q1 of this year, which is quite interesting. Now, if we dig in a little bit more into the article, this is some of the verbiage that GM is sort of communicating, or Reuters is actually communicating from GM. They said on Thursday we'll halt production at its Fort Wayne assembly truck plant in Indiana. Shares fell of GM. And after 2 years of U.S. automakers scrambling to keep pace with demand amid part shortages, GM's decision to cut production of its highly profitable pickup trucks signals a shift in the status quo. Now, if you've been following this channel, this probably doesn't come as a surprise. I've been tracking at least the GM, Ford, and legacy auto inventory levels from a dealership standpoint, because one of the things to keep in mind is that when a legacy automaker sells a car, they don't sell it to a consumer, at least in the United States, they sell it to a dealership. And if we look at the inventories at dealerships at the end of November 22, and again, this is a few months back, but it's recent enough to really understand why this is happening. The GM brands, in this case, Chevy, GMC, Cadillac, and Buick, are all above or well above what they deemed healthy supply at inventory at dealerships rather by the end of November. And so this production halt is obviously in direct contrast to the fact that these dealership lots are likely full and they can't take any more. And so GM has to stop production before they overflood the auto dealers. And I think this is in direct response to this trend that we're seeing. In addition, if we look at Q4's earnings report and we go back to some of the data sets that they showed, in Q4, they showed very little growth in revenue quarter over quarter, where Q4 is typically a really big quarter for automakers. And they also showed a big increase, a much bigger increase in inventory versus revenue in that same quarter, which again means that these cars weren't really being sold to consumers. They were being sold to dealers, and dealers are essentially being asked to figure out what to do with that inventory. So this is a very fascinating thing that we're starting to see develop, and automakers are responding to the fullness of those dealerships. And so I threw out a term in my GM earnings report when I reported on it a few weeks ago, where this channel stuffing thing, which is essentially moving inventory from factory to dealerships, would take hold. And it looks like it's starting to happen, at least with GM. So now the question becomes, how long is this going to go for? And are dealers going to be able to empty their lots in order to make room for the automakers to be able to sell them new cars? Otherwise, they're not going to be able to build any new cars. And now, of course, this is strictly for the truck market for GM, but we have to remember that the truck market for GM is by far its most profitable. So they are holding production on the thing that's going to make them the most money, which I think is not a great sign. If you do want more information from that perspective and how I covered GM, I have a video that I did 3 weeks ago, and I'll put a link for this on the video somewhere in this, probably in the upper right corner of this video. There's also going to be a link for it in the description. And there's my stupid freaking clickbait face. But anyway, let me know what you guys think of that if you have time to check that out. In addition to that, we're also seeing other news from legacy automakers. This was reported, I believe, just today, right? Yesterday morning. A new Ram 1500 is now selling for $63,000. Ram's total sales dropped 14.5% in Q4. Its lowest sales for the quarter in over 6 years. Might be some truck deals in the horizon. Again, there's this sort of trend of legacy automakers slowing down their sales, either because of demand or they're not able to produce as much, but the car sales are coming down. And this is from Car Dealership Guy on Twitter, a really valuable resource. I really highly recommend you check him out on Twitter. In addition, another Stellantis brand, Jeep just hit a 6-year sales low. You read that right. It will soon have no choice but to increase incentives to sell more units. Next couple of quarters should be heaven for cheap buyers. This was reported a couple of days ago in the morning. Again, more signs in the last few days that there's lackluster demand for these vehicles, and pointing more to these dealership lots being full and automakers not being able to move inventory from their factory to the dealerships. Where is the demand, right? And so that's the question that comes up to me for legacy automakers. Where is the demand? It seems like we're on this trend where there are slowdowns and people are not buying them, and factories have to be shuttered in order to ensure that dealership lots don't get blown out more than they have been already. If you contrast this to what Tesla has been doing in the United States, Tesla is up 44%, GM is up 3% in 2022 versus every single other automaker in the United States being down significantly year over year. And I will remind you that 2022 versus 2022, there weren't nearly as many supply chain challenges as 2021, yet they lost sales year over year. But there's one player, at least in the United States, that performed extremely well versus its peers. I want to dig into this a little bit more, but before we do that, I would love it if you throw me a like. It helps the YouTube algorithm show this to more people. Thank you so much. I remembered again to add the slide. Let's look at car sales per year for the United States. This is data I pulled from the internet. Where else would I pull this from? But essentially, it's yearly car sales in the United States starting in 2018, which was about 17 million units per year in 2018. And since then, we've seen this consistent decrease in car sales per year in the United States. We've gone from 2018 to 2019, 2022, 2021, 2022, rather 2020, 2022. And the car sales in 2022 were a little bit under 14 million versus what people are calling peak auto in 2018, which was around 17 million. So there's about a 2 to 3 million car sale delta from just 5 years ago in the new car market in the United States. And at the same time, where we are today, and this is a data set I shared yesterday or 2 days ago, the average monthly payment for a new car has increased to a record $777, nearly doubling from late 2019. So we've gone from this point at 17 million units down to this point. And, the sales haven't quite halved, but, they've gone down significantly, yet car prices have essentially doubled, or monthly payments have doubled. If you compare this to average new prices for a new vehicle in the United States, they've jumped to almost $50,000, up 30% since 2019, according to JP Morgan. Again, it's fascinating to watch the car sales being down, call it roughly 30%, 17 to 14. That's what is it? Roughly 30% sales drop. But you're seeing the prices being offset by 30%. Gee, I wonder why that is. You're seeing sales are down, prices are up. And this is the only way these legacy automakers are going to be able to make money, is by trying to charge more for their cars. And that's why I think you're seeing such a huge shift, or you've seen this huge shift into the pickup truck market and the SUV market, because that's really the only way these automakers are truly able to make money based on what their manufacturing processes look like today, right now. You got to make some money somehow. And I really think this speaks directly to that trend I just described. It's, I don't know, I think it's starting to play out quite clearly. And it's going to be fascinating to see how automakers are going to be able to adjust to the rest of the year, and what demand will look like for their gas cars, for their legacy sort of cars that they've made, and how quickly they can transition away from those gas cars to the electric vehicles, assuming that the EV is going to be this new so-called cycle that's going to allow the sales to go back up to 17 million per year or more. And what this really highlights deeply is just how unaddressed the down market is. So call it anything that's below $30,000. If you looked at those statistics we just saw, you have a car market that's shrinking, and you have prices for these cars that's going up. So what that means is that there's less new cars that are cheap or way more affordable. And with these cars, it's the hardest to make a profit, because the less you charge for a car, the less you have the ability to make money on that car, because the number itself that you're selling is down relative to an SUV or truck. So what you have to do is you have to sell a lot of them in really high volumes. And it's very difficult for automakers to do that. And that's why you're seeing that shift away, while we've seen those trends that we have today. I covered this more in depth in my video from yesterday. I'll put a link again for this somewhere in the video today, or that we're covering right now. I can't even use words right now. But I go more in depth about this thing that's happening, and how that down market can be addressed by a player. In this case, I think Tesla is super primed in the next 2 to 3 years with their compact car to absolutely dominate this huge gap that we have in the auto car market, at least in the United States. And then real quick, before we move on to some of these new players in Lucid and Lordstown, if you want to become a member of this channel, you can just click on join right below this video, or in a link in the description below. You gain access to our private Discord, and you also gain access to our private community forums that we host every Friday with my community. I'm so proud of my community. I love them to death. I'm biased, best community on the internet, but if you do want to support, do consider doing that as well. Some news from my boy Sawyer. Lordstown Motors Corp will temporarily stop production and deliveries of its pickup truck, Endurance, of which it has only made 31 units for sale. The company said, citing performance and quality issues with some components, which I think this highlights just how difficult it is, not just to be a legacy automaker in this environment, but just being an automaker, period, a new automaker. So this is huge bummer for this automaker. I'm hoping they can figure it out. In the same token, Lucid released their Q4 earnings yesterday, missing expectations. They lost 28 cents per share. Their revenue was $257 million versus $303 million estimate, so they missed the revenue, the top line, by quite a bit. And in 2023, they guided production to 10,000 to 14,000 vehicles. And what's interesting is they're not guiding to deliveries; they're guiding to production, which is fascinating. If we dig a little bit deeper into some of the numbers that Lucid has shared with us, in 2022, the end of the quarter and 3 months ended December 31, which is Q4 in 2022, their revenue was $257 million for that quarter. You compare it to the previous year, it's significantly higher, but the bigger line here is the cost of revenue, how much it cost them to make that much money. It cost them $615 million to make $257 million, which is obviously not a winning formula. If you put this within the context of how many cars they delivered in Q4, they delivered 1,900 cars in the fourth quarter of 2022. You take that number, you divide it into the revenue and the cost, you come up with an average selling price of about $133,000 per Lucid sold, and it cost them on average $318,000 to produce that same car, which means that they've lost roughly $185,000 per car sold in the fourth quarter of 2022, which just really highlights just how freaking difficult it is to build a car, especially if you're starting from scratch, because you need that scale to really get your costs to be baked into that car over time. And then you can spread it across tens of thousands of cars instead of just 2,000 cars, which is exactly what happened in this fourth quarter. If we dig a little bit deeper into the balance sheet for Lucid, you can see that the cash and cash equivalents they have on hand is about $2 billion versus the $6 billion from the previous year, excuse me. And there are other ways that Lucid can, they can take loans out. They have access to credit lines where they can raise this number up. But it just highlights just how much cash burn the company has suffered just year over year by trying to scale up their business. And so the key thing here for Lucid, for any new player really, is that scale is needed as soon as possible. They have to figure out how to deliver more cars, not just produce them, but deliver more cars so that they can absorb that cost it takes to build those cars as much as humanly possible and spread it. But what's interesting here is that this is not just a new car dynamic. This also applies to legacy automakers. If we look at this article from Gerhard Horn. I'm so bad with names, and I hope I pronounced Gerhard correctly, from Industry News. This was from 3 days ago. Ford's dysfunctional production is eating into profits. And sort of Jim Farley, the CEO, is talking a little bit about how they have dysfunctions, but I want to read this last paragraph here. In 2022, Ford issued more recalls than any other manufacturer, which isn't the kind of accolade you want tied to your brand. And all of this is in addition to an $8 billion cost disadvantage compared to Ford's EV producing rivals. Simply put, how Ford designs and builds EVs is too inefficient to make a decent profit. But here's what's important. Ford is really the only player that's legacy that's actually trying. Ford is actually trying to transition to an EV future by betting hugely on the Ford Mach-E and the Ford F-150 Lightning. So let me do a monologue now. Get ready. I hope this is good. I really think what's happening now is that Ford is taking a huge brunt as a legacy automaker from the news, saying, look at how bad they're doing. Look at, they're dysfunctional. It's terrible. They're doing such a bad job making money. And if you look at their Q4 earnings, they took a lot of losses, but they were very upfront about why they were going through that struggle. And I believe it's because Ford is actually being transparent about how difficult it is to be an EV manufacturer in this landscape when they're trying to transition the company. Every other legacy automaker hasn't really invested nearly as much time into that transition compared to the rhetoric that we were getting from Herbert Diess back when he was the Volkswagen CEO. He was so big about saying, if we don't switch over, we die. If we don't switch over, we die. He was being transparent about how difficult it was. They kicked him out and they brought in somebody else that's not having the same sort of rhetoric. And so I think Ford here is being unfairly picked on by some of the media by being upfront about some of the challenges. And so what my gut tells me is that these challenges that Ford is having now and the challenges that Lucid's having and Lordstown is having and everybody else is having, really except for Tesla, is going to start hitting the other players massively because they're not really being upfront about how difficult this is. Or the flip side is that they haven't actually sold any EVs. How many EVs have the other players sold? If you look at GM as a percentage of their total sales, the Bolt is quite small, but it's a regulation car that's mostly sold in California. They sold 200 or 300 Hummer EVs in total, and that's really their entire EV bucket. Honda doesn't really make an EV. Toyota doesn't really make an EV. There's all these other players that don't make EVs, and that's why they're not getting that attention. But once they have to, with this falling auto market, the shrinking auto market, I think that attention is going to be on those players much, much louder. And it's not just going to be, oh, Ford is dysfunctional. It's going to be, wow, legacy automakers are having a hell of a time transitioning. And all the while, you have a player in Tesla that's shipping probably 2 million cars or close to 2 million cars this year in 2023, with aspirations to be much, much larger with that compact $25,000 car that they may unveil next week. We'll see what happens. But let me know what you think. I would love to hear your thoughts in the comments below. It seems like this sort of thing that a lot of investors in Tesla that have been following the story and the legacy automakers are starting to see sort of this thing really playing out. We're getting some news articles. Again, this is kind of short-term commentary, but it could be a signal for the broader picture of what's to come here in the next few quarters and years. So do let me know in the comments how you're thinking about my sort of what I presented, if I'm on the right track, on the wrong track. I would love to have a healthy discussion with y'all in the comment section below. And before we move away, I just want to let you know that if you do want to support the channel, I have merch in the description below. And I'm also wearing a shirt right now as well. Let me see if I can go back. It's a box. I wonder why. It's tied to one of my videos. I actually kind of really like this shirt, but do consider doing that in the description below. Or I also have a coupon code for Athletic Greens, which is a supplement that I use every single morning. I love it. It makes me feel great. I've been taking it for a few years. I got turned to it by the Joe Rogan podcast. And thank you, Athletic Greens, for giving me a code that you can use in the description below to get free travel packs and free vitamin D as well with your Athletic Greens. Thank you so much for watching this video. I hope this was informative and helpful, and we'll see you in the next one. Take it easy, everybody. Bye-bye.